Well, good afternoon and welcome to this week's presentation of a webinar by Barrister Booth. My name is Per Oscarsson. I'm a member of the Estate Planning and Probate Group here at the firm. With me today is Mary Jones. She's an enrolled agent, with the IRS, and she is with the Hagen Firm here in Edmonds. And our topic today is going to be federal estate tax returns and Washington estate tax returns. Mary, thank you for joining me today.
Absolutely. Glad to do it.
So just the first question that I would have is a federal or Washington estate tax return required to be filed for every estate?
No. So the federal exemption is now up to 12.06 million. So we don't file very many federal returns based on the requirement. The Washington limit is only 2,193,000. So if the estate is worth more than the 2,193,000, then an estate tax return is required for the state of Washington.
Okay, and I know that there's talk with the federal limit potentially changing in, was it 2026?
January 1st of 26, it's set to revert back to 5 million.
But that's also subject to change, given that we don't know what Congress is going to do.
We have no idea. I think it'll depend greatly on who's in the White House in 2024.
Okay. And with the state, I know that the state threshold has been the same for the last 5 years. And
they tied it. The state tied it to a table for like cost of living increases that's no longer published.
Mm-hmm.
So when you multiply it by 0 each year, it turns out the answer ends up being 0 increase each year. So yeah, it's working for them.
And it's kind of strange to me that they haven't fixed it.
Yeah.
Because I know that both the statute and the regulations both refer to that table specifically.
Right.
And I think the table ceased to exist in, was it 2017?
Yeah, it's been gone a while. So, it started at 2 million and it was increasing and then it just stopped. And I think because it's working in their favor, they're happy to let it sit until somebody challenges it.
So that filing threshold, is that calculated based on the gross estate value, or is it the value of the estate after you take out any applicable deductions or exemptions?
Unfortunately, whether or not you meet the threshold of the 2,193,000 is based on gross value. So, if you have a $3 million house with the $3 million mortgage, unfortunately, the 3 million counts in that calculation, even though you would say net that house has, in essence, 0 value because it's fully mortgaged. Mm-hmm. That isn't how the state determines who must file. You would get that deduction, that mortgage deduction on the return. So you may not pay any tax, but you're still stuck filing. Which is
okay.
A hassle.
And is same true for the federal?
Same true for the federal.
Okay. And if the estate is not required to file an estate tax return because the value doesn't meet that threshold, are there any other reasons for filing a return?
So there is for the federal. So if there is a surviving spouse, so on first to die with a married couple, if you file the federal return and you don't use the exemption, which is the 12 million, 12.6, you can do what's called the deceased spousal unused exclusion. And you can basically say, okay, my spouse died, there was 12 million available, we didn't use it, so I'm going to transfer it to the remaining spouse. And now the remaining spouse has the 12 million that they just got from the deceased spouse, plus whatever the exemption is when they pass away. So even if it reset to 5, you'd have that excess, they call it DSU for the acronym. You would have that in essence in your pocket for deciding whether or not the remaining spouse at death would be required to file with the feds. And the IRS has said that there would be no clawback of the DSU, meaning even if the estate tax threshold reverts down to 5 million, if you filed and did that election to pass the remaining exclusion to the remaining spouse, that will hold.
Now, if the federal estate tax reverts to 5 million,
Mm-hmm.
let's assume that the first spouse dies a month before that happens.
Mm-hmm.
And so the estate tax return isn't going to be filed for several months potentially.
Mm-hmm.
Could the surviving spouse still claim that unused exemption at the 12 million level, or would they only be limited to the 5 million since the death occurred while it was 12 million?
It's based on when the death occurred.
Okay, so they
Yeah.
can still claim it after.
They
because
could.
the death
It's not
occurred
based
before.
on the filing date. It's based on what the exemption was at date of death.
Okay, and so in your example, you would have the 12 million unused exemption, and the
Mhm.
surviving spouse would have a 5 million exemption for
Right.
a total of 17.
Exactly, which
Okay.
makes it so very few people, at least that we deal with, would be over that, 17 million.
Okay,
That's a lot of exemption to have. Unfortunately, the state doesn't have anything like that. It is a
That's
use it
okay.
or lose it exclusion. When the first spouse dies, if you do not use the $2,193,000 exemption, there is no way to, in essence, give it to the remaining spouse. They do not use the same as the feds. And if you don't have to file with the state, there is no reason to file with the state, and you wouldn't want to.
Oh, okay.
Meaning, so if you're under the 2,193,000, you might still file with the feds to get that exclusion transfer, but you wouldn't file it with the state because there's no value in it,
Okay,
because you're not getting anything.
right. And so the only way to get that unused exemption is
Is to file a federal return.
whether
Now, the
you have to
one-
file it otherwise or not.
Exactly. So the one positive thing is that the Washington return is basically the federal return with 3 additional pages at the front. So if you're filing a Washington return, it's really easy to file the federal return as well, because there isn't that much extra work to do.
I was wondering if they're enough similar that
They're
not
very,
identical.
all the schedules that you have
Mhm.
for asset listing and all of that, they are all the same. So,
Okay.
if you're gonna file with the state and there's a surviving spouse, you certainly want to file with the feds and take advantage of that DSU that you can transfer.
Okay. So can you walk me through the kind of the process of preparing the estate tax return?
So it's big, not gonna lie. So you generally, obviously, you have to go through the will and make sure that, obviously, that's on the legal side as well, which we don't handle. And the attorney's dealing with probate assets and all of that. But on our side, we start by collecting all of the, you have to have proof of every asset. So it's a little like a balance sheet return rather than an income tax return.
Mhm.
Because you're really taking an inventory of all of the assets and liabilities at date of death. It's like taking a snapshot. So the bummer is not only do you have to have the amount, you have to prove it and attach proof. So you're going to, banks to get bank statements that cover date of death. You're going to your broker to get listings of all the holdings in your brokerage account at date of death. Same with your IRAs, and getting a valuation for properties, real estate that are held. So it's a big it's a big deal to file, and it's not cheap on our end.
And when you're talking about the assets, you got to include the probate assets, which
You have
are
to
the ones that are
include
subject to
every
loan,
asset.
but
So
yeah,
even
also
if
the
you,
non-probate.
exactly. So
Yeah.
even if you have, because we're community property state, even if the spouse has an IRA and that spouse is still alive, that still is included on the return. So you're really inventorying all of the assets, and whether or not it's probate or non-probate is neither here nor there for the estate tax return.
Okay.
Although in addition to that, so once you get the number, there's also time spent dealing with whether or not trusts are being funded and what assets are funding those trusts. And some of that has to be shown on the estate tax return as well, because you're not only coming up with a number, then you have to say, okay, let's say the numbers, there's 5 million. You have to list who's getting that 5 million and how much are they getting. So if there's a trust that's funded, you have to have dealt with that and how much is going to each beneficiary.
Oh, to each beneficiary. Okay.
Yeah.
So not just the fact that it's going into a trust, but who's ultimately going to benefit from it.
Well, the trust, you have to attach a copy of the trust document. So that's how they determine that. So you would just list the trust name, tax ID number if there is one, and the amount. And then if there's individual beneficiaries, again, you list their name, their social, and the amount that they're getting.
Mm-hmm. Okay.
So some of those decisions have to be made before you file the return.
Right. And the deadline for filing the return?
9 months from date of death to the day. Meaning
to the day.
It doesn't go to like the 15th or anything like normal tax returns do.
And that deadline is the same for federal and for Washington?
Yes.
Okay.
And you can get a 6-month extension with both the feds and the state. That is an extension of time to file only, not an extension of time to pay. So if it's a return where there's going to be a payment due, you would need to make a payment at the time that you extend.
Effectively,
Or
a
else
deposit.
pay a penalty when you actually do file.
Right.
Yes.
So you pretty much have to then make a pretty good faith estimate.
You
If
do.
you're going to seek the extension, you got to make a good faith
Mhm.
estimate of what it's ultimately going to be. And I would assume you almost have to go through the whole process of completing the tax return just to get the estimate in order to get a reasonable estimate.
Correct. Yeah. So you are on the
And
clock on a tax due return.
so how close does the estimate have to be to the ultimate? Because let's say you're $20,000 off on the amount of tax that's due. You
So
make a
then-
deposit for 50 and you end up owing 70.
Right.
How does
So
that work?
there's actually, the state's pretty generous on that. They charge interest on that.
Mm-hmm.
And I think right now they've upped it. It was like 3%. I think with inflation, I think they just upped it to 5%. It has some correlation to federal AFR rates and that kind of thing.
Okay.
So you're really just paying them interest of the amount that should have been paid when you extended. So it's really a calculation between those two.
But I would assume at some point, if your estimate is significantly lower, there may be a penalty assessed. But if it's been a good faith estimate, no penalty, just the interest.
They really don't charge a penalty. They really just charge the interest, the state.
The state does. Okay.
Yeah. So now they're doing some, we just dealt with this with a client where the estate sold some property, and during all the time with the title company and everything, they asked if the estate would owe Washington estate tax and wanted to do a holdback
Mm-hmm.
of the money made from the transaction if you hadn't, in essence, already made a good faith payment to the IRS or to the state of
Or to
Washington.
the state, yeah.
Yeah.
I've seen that several times. in
So
trouble.
they're getting more aggressive on making sure that they, get their money.
Yeah, okay. I think you already said that the information that you need for the federal return versus the Washington return is pretty much the same.
Pretty much the same.
Okay. And I think you also said that the returns can be difficult to prepare, although if you prepared the Washington return, preparing the federal will be relatively easy.
Yes, exactly.
Okay.
But they're time consuming. There's a lot of detail in the tax returns as
Mhm.
well that has to be entered. And then of course, all of the attachments and they take about, on estimate for us, 25 to 35 hours of time spent
Okay.
on each return. In
And
general,
typically, I'm sorry, good.
just in general, that's
Just in
about,
general, okay.
Yeah.
And I would assume that the greater the complexity of the estate, maybe more assets may
yeah,
or may not increase the complexity of the return.
correct. Number of assets obviously comes into play because you're collecting more information. But the value of the estate doesn't necessarily change the complexity, because you could have a really high value estate and it really only has, 5 assets to speak of.
Right.
It's the clients where they pass away and they've got, 12 bank accounts and 4 IRAs and all of that,
Right.
it becomes more complex and time consuming.
And so when you do the returns, it's going to sound like a funny question. How close do you have to be on the value? So for example, if you're doing whether you're doing a federal or a state return, do you need to have an appraisal of every item? I mean, I would assume with real estate, just getting a broker opinion of value or a Zillow value or something like that is not going to be enough.
Yeah, well, we recommend for just residential real estate that a broker opinion of value that includes comps is good enough. Commercial real estate, you need a full appraisal because value on commercial real estate is set with more complexity on, rents collected and that sort of thing. But it does set the cost basis going forward. So obviously you want it to be as close to, accurate as you could be. But sometimes, the market changes, and if the asset sells within 6 months from date of death, we generally use the sale price as the value of the property.
Okay, so and that could be greater or lesser than the date of death value.
It could be, yeah.
Could be. So if you use the value at 6 months, if the sale happens in 6 months, do you have to use the value of all the other items in the estate at 6 months, or can you use the
So that's if you choose the alternate valuation date. So there is an option with both the feds and the state. If the estate has decreased in value from date of death to 6 months exactly from date of death, then you can switch and value every asset at the 6 month date and use that instead. We haven't done that in a long time, but now that the market's softening and everything, that may come into play again.
And the first example that you're using where you had the sale in 6 months, there everything is still being based on the date of death value, but you're allowed to use the sale value.
You're allowed to use the sale value, and often the sale value is higher than it has been, higher than the BOV. And in that case, the state usually makes the argument that the sale price is the real value, not
as opposed to the date of death value.
Exactly. You'd
Okay.
have to be able to argue that there really was a change in market value in that time frame.
Of course, that would also seem to weigh in favor of the state, because if the sale value is
Everything,
greater, they get more tax.
everything weighs in favor of the state. There isn't anything that doesn't work that way.
No, okay.
There are no dummies.
Yeah. So when you've gotten through the process, you've got the tax return filed either with the IRS or with the state.
Mhm.
Do you receive any kind of a notice from them that the return has been accepted, and if whatever tax due has been paid?
So with the state of Washington, they will send a letter acknowledging that they received it and that in essence, it's going into their queue. Once they have gone through it and agreed to it, they will send a letter saying that yes, they have agreed with it, taxes have been paid, but they want a copy of a closing that same letter from the feds if you filed a federal return. So you have to get the letter from the feds and send it to the state in order to get a final closing from the state. Although
Okay.
they'll give you that preliminary one saying, hey, the only thing we need is that one piece of paper. The feds used to mail out that information. Now you have to go back and request it and ask for closing. And if you request a letter of closing, they're now charging $76 per request for the closing statement. Or you can go out, we have a practitioner account. You can go out and get a transcript of the estate return once they've finalized it, and the state will take that as well, which at least there you're not paying the $76.
Okay. And so typically, and maybe typical now in the last 3 years is not typical of what it was.
Right.
Typically, how long is it taking from the file? Let's go with the federal. Although I think you said you're not doing an awful lot of those nowadays.
Well, we're filing them generally for DSU only for the
Okay.
unused exemption. So only on first to die marital. So the IRS won't even let you request any of that information until you, it's been 9 months after you filed.
Okay.
COVID has definitely slowed them way down because they didn't open mail for a long time at the beginning of COVID.
Okay.
So I would say they're a year out, probably for the feds.
From the date of filing.
From the date of filing, and the
Okay.
state is generally about the same. It has been 12 to 18 months. They generally pick up returns where there's money paid faster than returns where there is no tax being paid.
Okay. Interesting.
They don't like to, because a lot of times they're extended, and we generally try to err on having the client overpay on that extension, and they have to pay you interest back if they owe money back. So I think that's why they are more apt to pick up those returns where there's money on the table.
And when they pay interest, do they pay at the same rate that they charge for the underpaid tax?
It's close.
It's close. The float or something, yeah.
Yeah.
Okay.
Yeah, something in the float there. Yeah.
Yeah. Okay. Well, Mary, thank you very much for joining me today. I've really enjoyed our conversation, appreciate it. And I'd like to invite our audience to join us next week when our family law group will be presenting a webinar. And unfortunately, I can't tell you the topic because I don't know the topic. So I thank you all for joining me again, Mary. Thank you very much.
Yeah. Thanks, Per.
You bet.
Mhm.
Bye-bye.